Good evening, Mr. Tjiramba, and thank you for joining us here on Business Today.
Good evening, and thanks for having me.
Let's start by discussing the rationale behind the pension-backed home loan and the modalities that GIPF will apply.
Thank you for that question, and again, thank you for having me. It's an important discussion, conversation. We are definitely alive to the fact that it's something that is very topical in the country right now. Even people who are not members of the fund themselves, they also have opinions about it. So the GIPF is the largest pension fund in the country with over 100,000 members. Is purposefully very member-centric. So we do know our members' needs and their aspirations. And it's without saying that the housing issue in Namibia is also a topical issue. The fact that many Namibians do not have a roof over their head, and our members are not excluded. Provided by the Ministry of Finance as far as 2019, out of 9,000 civil servants, about 70% of them did not own a house, meaning many people are renting or staying elsewhere and they do not have a title or a bond that they are paying. This is regardless of the fact that our government has one of the best housing subsidies in all of Africa, if I can say so. And that is also beside the fact that in around 2019, the GIPF also rolled out a housing scheme under First Capital, which was a mortgage-backed home loan scheme. Mortgage-backed in the fact that once you get a loan, your house becomes the collateral. And when you default or you don't pay, the financing institution simply repossesses the house, sells it, take their money, and give you your difference. Now, the pension-backed home loan, a certain portion of your pension is now serving as a collateral. So you won't be asked to give any other security towards this. You already have that part. And I'm sure in the discussion we'll talk about, but what part and how much is that? And that is what it is different. And another exciting component about the pension-backed home loan is the fact that unlike mortgage-based, where you could only build in a proclaimed area, here you can also build a home in an unproclaimed area, which is meaning in our rural areas, in our villages, where the majority of our members do retire to. So the fund in its right wisdom, the board felt, but let's do something that would be meaningful, that will be a game changer, that will change even the look and feel of our villages, where people now who retire have also changed the face of where they go to retire. So that was the whole thinking of why the fund then went through a very elaborate process of over a number of years to change the rules of the fund to be able to allow this to happen. Because as a defined benefit fund, the benefits to our members are predetermined and they are guaranteed. By the time you join the GIPF and you are a registered member, in the second or third month, knowing your annual salary, we will already be able to tell you, come the day you retire, this is the lump sum you will get as a 1/3, and this is what you will get per month until you pass on. And that's why we say ours is a lifelong pension.
Mm-hmm. And is this an automatic qualification for government employees as long as you have accumulated a balance on your pension amount?
I can say so, yes. Mm-hmm. But we have to look at a few factors. A young person who just joined the fund this year or 2 years ago, let's say as a young teacher or a nurse, might not necessarily have accumulated enough savings as a transfer amount in their kitty to be able to afford or to be able to to exercise this option. But when you look at somebody who has been in the civil service or a participating member for a number of years, let's say somebody who has been working now for more than 15 years, definitely they stand a better chance to have a better part in the kitty for them to be able to participate. But then again, also, it's not only about the number of years, because some people come into the civil service at a very senior rank. And the more money you get, definitely the more pension benefit you will accumulate in that period of time as well. So it's a combination of everything. So a member will just have to look at their income statement from the pension benefit statement, and then they will have to make up their mind as to what it is they can afford.
And from a balance, how much of a portion do I qualify to get from that balance that I've accumulated?
What we talk about is your withdrawal or transfer benefit. And there is two benefits I need to explain in the income statement of our members. You get your cash benefit. Your cash benefit is basically your contribution that you have made to the fund since the day you joined. But the transfer benefit or the withdrawal benefit also has your employer's contribution. So that tends to be a bigger amount. So in terms of the pension back home loan scheme and rule, you will be able to access a third of that withdrawal benefit, or 33.33%. Let me break it down further. Let's say your withdrawal benefit is $1 million. That means you qualify for about 333,000 plus as something you can take and as that will stand in for you to access this loan. And with that, you can decide what it is you are going to do with regards to a house. And we will probably talk about the various options of what it is the loan is meant to cover. The other day, I was looking at a member who has worked for 30 years. Their accumulated withdrawal benefit is something like 3.8 million. So when you look at that member, they will be able to access at least 1.something million for this particular scheme. And then you have the repayment period until you turn 60.
Let's zoom into this by using the example of commercial banks. When you approach commercial banks seeking for such a facility, they consider or they look at the aspect of affordability. They go through your payslip. Will this person be able to afford? Of course, remember the labor law and NAMFISA regulations. They give a certain amount of which you can deduct from a person so that the person can be able to afford living further. In this case, GIPF, are you also going to look into the aspect of affordability and either approve and disapprove, or how are you going to approach this?
It will be highly irresponsible if we don't look at affordability. Because when you look at it, at the end of the day, the labor law is also very clear. You cannot just give somebody a loan, or you cannot just subtract monies from a person's salary until they are not able to go home and buy bread for the children. So there has to be some type of an affordability test. But what we are doing under the scheme, we are waiving some of the unnecessary things that are also keeping people away from affording. Things like now you are listed at ITC for owing a clothing store $200, for instance, or you are required to go for medical testing. That does not really make sense. So it's some of these unnecessary red tape that we would not consider, but definitely we would want to see whether you can, for the amount you qualify for, whether your pay slip will allow you to have a breather per month to be able to do what you need to do. Perhaps you might not be right out told you cannot afford, but you might be told with what you have now, you might afford to take only a certain amount. Or you might be advised to say But why don't you maybe consolidate the debt you had out there and over these few months pay it off and come back and let's talk. So definitely the affordability test will have to be there because at the end of the day, we are also looking out for your well-being. And you cannot just say you want to do this at all cost. It is not responsible to do so.
And this same loan will be paid back with interest. And the main question is, this interest, who is it going to? Who is it going to benefit? Is it going on top of my loan that I'm paying back to myself, or where is this interest going to?
It's an interesting question, and we are getting it all the time. Now, the loan, first of all, it's being administered in terms of the Pension Fund Act, Act 24 of 1956. And this law does not only apply to the GIPF, it applies to every pension fund in the country. And many of the pension funds have been having pension-backed home loan schemes. And the law provides the interest rate at which any loan has to be administered at. Right now, the law says it's repo rate plus 4%. And the repo rate, as me and you know, is the rate at which a commercial bank may borrow money from the Bank of Namibia, and then they do their own markup. But when it comes to housing and when it comes to housing loans under the Pension Fund Act, it says repo plus 4. What we have been able to do, what the fund has been able to do through its consultative meeting with its stakeholders, and especially our unions, who also sit on our council, on our board, is to try to negotiate for a more favorable rate for the members, to the extent that our government, being a listening government, has now agreed, and it has been gazetted, that the rate now stands at the repo rate plus 2.5. And it will not only benefit our members, it benefits the whole industry, because the law would not only apply to the GIPF once gazetted, it applies to everybody. So, now to come back to your question, to whom are you paying the interest rate to? You are paying back to the fund. It is your fund. Because at the end of the day, what we want to see happen is, you have gotten the 300,000, you have 20 years to retire. We want you to repay back that money so that by the time you turn 60, we would have restored you to the original position you were in.
It's like you haven't not taken anything.
But the beauty of it is you already have a home. When you get your 1/3 tax-free, your lump sum tax-free, you are able to do other things with it. You are able to reinvest to make sure you augment your income as a pensioner, or maybe you start a small business, or you do something else with the lump sum cash you have. Now, people are saying, I take 70,000. It's my own money. I said, take an example of a $20. If you have a $20 today, my friend, and you go to the store, you might buy bread and something. But that same $20, if you keep it under your pillow, come next July, you go to your same shop, it might buy you nothing.
Exactly.
And mind you, with 70,000 you have taken, and after 20 years, it will mean nothing. That's why you are paying it back into your kitty, into the kitty, which is a pool of funds for everybody, so that it does not disadvantage everybody. The ones coming in that are still trying to build up their pension are also somehow also subsidizing you, so that when you pay back, when their time comes, they have been there 5, 10, 15 years, they are also able to access the same pool of funds. So as a GIPF, we do not make a profit out of administering the fund. What we want to make sure is we have promised people pension benefits. And we have promised benefits that we are saying at the strength of our net asset value, we can pay pension benefit for the next 70 to 80 years. And that is based on a sound investment philosophy and prudent financing of these funds. So when the law says, if you give somebody a loan, there has to be an interest paid to it. So our members also do have a choice to say, I will just have my money lay there and I will wait for retirement. But we are saying, invest in something that will make a difference the day you retire. And that's why you pay the interest. It's not to somebody, it's not to enrich anybody else, but it's to yourself
That's
and
correct.
to your own fund.
That's great. And GIPF has given or appointed 2 companies to administer this whole process. And the question is it really necessary for GIPF to use what critics are now calling middlemen? Does it mean GIPF as a fund does not have the capacity to run this with minimal cost?
We have over the 30 years that we are in business built enough capacity and expertise in administering pension. We have almost perfected the administration of pension funds, of just being able to get our data in line, to do our, when we have to pay out claims in a record time. We are able to do funeral claims within 24 hours. We are able to pay a death claim within a month. So there are so many things we have perfected. But we also do not shy away when we say we do not have a record book of ever having done a loan. And when we start something like this, and this is also not something small, when you say another pension fund is doing it themselves, also look at their membership numbers. We are sitting with over 100,000 members. And we are sitting over administering this project for the first time with a startup capital of about 900 million. So we are talking big money. So we have then gone to industry, we have gone on a public bid, and we have invited interest for people who have the expertise to administer and run a pension back home loan. We got a lot of interest, also including commercial banks. The 2 entities we have ended up chosen have also done this before. First Capital, which by the way, is also one of few fund managers that the fund also have a big stake in it, as we owe a certain percentage of their ownership, have been administering for us a mortgage back home loan that we have financed for up to 1.5 billion. And now we also have extended Kuleni, which is a subsidiary of the fund, to administer this product. So when we looked at whom are we going to use, we also looked at what people were providing to us as what the cost will be. And we will definitely go for what is more affordable to our members at the least, but at a most efficient manner as well. And to be honest, there is nothing that will prevent the fund from saying we have now observed this for a year, for a 2 year, we are able to build capacity here and do it ourselves, or we are able to reach out to one other entity because we are not able to meet the demand, the supply for the demand that is there, and we can scale up or scale down. That is perfectly within the armpit of our board to do. But for starters, we have gone for people that we know have been tested to do this. Kuleni, for instance, run our members of parliament pensions. And that particular part also has a pension back home loan scheme that they have been able to do. For the GIPF, they also run our staff part of the pension back home loan, which they have also been able to do well. So we were looking at companies that has been tested to do this and that can scale up their capacity to do so, and which we are also happy to build that capacity because we are looking for it as it is a capacity that we are building. So it is perfectly okay.
Okay. Back to borrowing. Take us through as to when the borrower receives this money. What is that they are allowed to do with this money, and what is that they are not allowed to use this money for?
Okay. The loan is specifically, you can buy an earth in which you will build a home. You can buy an existing property. You can get the loan to build a new property. You can get the money to pay an existing bond you have with another financial institution, or you can get the loan to make renovation to a property that you already have. So basically, everything is surrounding something that is immovable. The loan or this facility does not allow you to buy cattle, to buy a Land Cruiser, to buy a nice bribe thing that you can put at the end of the bucket and go to the beach with. So there is quite, the rules will put up quite an elaborate list of things that you can and you can't do. But mostly it is for immovable property.
Inside the house itself, there are some movable and immovable items. For example, washing machine is a movable item that one can move from house to house. Building stove, that one is immovable. Does it mean, give us an example in the, giving us with these two examples. How will the fund decide in that line?
It's very clear. Let's say you are building a new home. Excuse me. Your quotation is fund to include installation of air conditioning, because that is a permanent fixture in the house. A built-in stove, a wall around the place, electric fencing. It's baklabas. It's things that are part and parcel of that building.
But a TV are not allowed.
A TV is not allowed. Couches are not allowed. A fridge is not allowed. A microwave is not allowed. You cannot go and buy expensive cutlery. You cannot go buy a washing machine. So those things that would not be part of the house would not be allowed.
And are there any gatekeeping measures in place to ensure that borrowers do not misuse the funds or use the funds for something that was not meant for? And how are you going to do inspections, site inspections, after how many months?
The fund will do an elaborate member education and campaign to really popularize the scheme once it is officially launched. The launch will follow when we have now signed an agreement with the Office of the Prime Minister, and also when we have signed into agreement the service level agreements that we will have with the service providers, the two I talked about. And it is in those service level agreements that there will be clear stipulations as to what their duties are and as to what our expectation as a fund will be. For starters, I am told we will require quarterly reports that will have to come into the fund. And part of that is also to say, now you have provided a quarterly report as to this is how much financing you have done in this period. These people have built this number of houses. They are up to a certain level, and now you want your drawdown on the funds that you need to get. So, and you have to show proof that you have done your due diligence, you have sent out your evaluators, you are comfortable that this is what has been done. The person you are building for has also signed off to say, at this level of development, I am happy, we can move on to the next stage. So it is these prudent measures.
Moving on to the next stage, does it mean as a borrower, if I qualify to get 300,000, I'm not going to get that 300,000 in once?
You would not get it at once, because let's say you are building a house. The house you are building is also built at various stages. Even the houses that for those who build, who just don't buy a house that is already existing, when you have gone to the bank does not give your contractor the whole 300,000 to go and build and go away. What if they don't build? So they also have a mechanism to say, you build up to a certain level. You do the foundation, you get your money. You build up to above window level, you get your money. Roof and everything is done, now it's plastering, now it's this. I'm not sitting here and saying these are the various steps, but there will be various criteria that will be used in the service level agreement where we will know at what stage is this development and what is the drawdown that has to be made against this fund for this administrator to get the money. In order to just make sure that there is not abuse of the system.
And those that will be defaulting from the agreement, that will be found like you have used this money to buy cattle or a car, what are the consequences? What will happen to them?
You see, that's why we have an agreement with the Office of the Prime Minister, because that is the employer of the majority of our members being in the civil service. So basically, if you default because you have somehow done something that you were not supposed to do, right now we are also saying, under no circumstances should you be able to get the money to buy a cow or a bull or cattle, but somehow if underhandedly, maybe you collude with your contractor and they get the money and you get it on the other hand to do something and this property is not built, you will be the one held accountable for. And it will be required of your employer to discipline you within the disciplinary procedures that are available for that particular employee. It's not only that the fund will be available to people who are in the civil service, we also have state-owned enterprises that are part of the fund. And they too have their own disciplinary measures that they should follow in case a member who has taken part of the scheme defaults through fraudulent manners.
SOEs that have implemented the same facility, they have two options. One, either the money goes to the borrower, to their bank account, or a contractor, in this case, GIPF. Will it only give one option to a contractor, or how are you going to deal with it?
I'm not aware of those specifics of other SOEs and how they do it. I remember I also was an employee at an SOE, at the university to be specific. And the only time that the money could go towards your bank account is if you took the options to say you are paying off an existing property, to which they will then pay it towards your bond to pay for that. But whether they would pay for you to get the money straight to your account to go do whatever you want with it, that I'm not aware of it. And I'm not saying that's what your question is alluding to.
Yeah, it is.
Yeah, but for us, right now, we do not have that as a provision. We would rather have the administrator pay the contracting entity you have taken, and our wish is also that that the administrators will be open to the fact that they also have to look for capacity within our regions. If people are going to build in rural areas, the last thing we would also want to see is for them taking up these very high and expensive contractors in cities and taking them to build houses at unreasonable rates in rural areas. There are also people out there who have the capacity to do this, and we would want definitely, the hope is to have people who are not fly-by-nights, people who are registered duly with all the entities within the country to do what they need to do as professionals, but they should also be grounded in the communities they are so that they are able to do this at very affordable prices. But for monies just to be given to individuals, we know more than not what that end result will be, and it will defeat the purpose why we have the scheme.
And let me take you back slightly. What makes the government-backed home loan stand out and affordable against commercial banks? I'm giving you an opportunity as GIPF to sell your product here.
It is basically just the fact that we have, it being a pension-backed home loan scheme, it is at a preferential rate, interest rate, that repo plus 2.5. I mean, when you compare that against the prime lending rates right now for housing in the market, they are probably where you have 9.75 or 9.25%. And we do know that repo rate, these rates are variable rates. It can go down, it can go up, but still, if it goes up for everything. And definitely, it still remains preferential. So for that, we say for our members, it's a better interest rate. And on top of it, for the first time, they are now under a scheme where they can also have the opportunity to build a retirement home in an unproclaimed area, which many of our members I have talked to during my various stakeholder consultation I have countrywide, that they welcome and that they are actually willing to take part of. And we know building a home in a rural area will also not be as expensive as it is. As long as you have a customary rent right over the land, you don't pay for the amount we pay for an ERF in cities, definitely. So that is my selling point. That is why we are saying, at the end of the day, we want our members to really have a good uptake on this product because it is for them, for nobody else.
There is a quarter of society that does not entirely agree to the scheme, and I know there is a process still to be taken by the Office of the Prime Minister. Is it too late for the critics to challenge GIPF to stop the scheme?
It depends who the critics are, because the scheme is meant for our members, and our members are the ones who wanted it. So it will be interesting to know what their interest is as critics and what it is they stand to gain by opposing it. It is not meant for them. It is meant for our members. Our members want it. Our members have representing unions. They're representing unions that has a very significant and high chair at the table where decisions are made at our board, and they have been part and parcel of taking this decision on behalf of their membership base. So definitely we are in a free country, but I will be more than interested to know what is it they are opposing and to what end.
And when exactly is this facility expected to commence? Because I understand you say the process is still ongoing to do final touches.
I can unfortunately not give you a date specific, but what we also do know is the fact that we await official signing of a memorandum of understanding between the fund and the Right Honourable Prime Minister at a time and date that we will be advised to do so. And after that, we will have to then sign our service level agreements with the two administrators, and then we will have to onboard them onto the process. We would want to make sure that everything is ready to go by the time we come here. I come to sit with you to say we are ready to go and our members can now go. And perhaps maybe, if I may, is to also tell you the process, how it will go. Our members, the first thing they will make sure they should have in their hand is their benefit statement. And that benefit statement they can get by just going onto our self-serving portal on our website, by using their GIPF membership number, and they can print it out for themselves. For those who don't have access to a computer, they can actually go to our nearest office, and we have a very wide footprint because we have an office in almost every region in the country. So they can go to a nearest GIP office and get a copy of their benefit statement, which will clearly indicate what is that 33.3% for each member translating to. With that, they will go to their HR office. That's where the application process will start. Once the applications are done at HR, they are given to the fund to do the assurance vetting, to say this percentage is correct and all of that, and then we give over to the administrators to do the rest of the things. And then once you are approved, you are told money is dispersed to the administrators, and your house can commence. And it is paid off at certain intervals, as we have talked about in the interview, and that's how you go about it.
My second last question to you before I let you go. What if a borrower takes this loan today and after 2 years they resign, but they haven't finished settling the balance, what will happen in that case?
Let's pause back. I did say what you qualified for is a third of your transfer balance, which means if you take a third, you are still left with a balance of 2/3 in that 1/3, in that 33% of your withdrawal benefit. So basically, should you then resign, you still have money with the fund and you have not paid back. So we only take what you have already been paid, and from your balance, you only get what you are owed. Let me take a good example. Let's say what you have in the kitty is 200,000, but you only chose to take 70. You are left with 130. Now you resign and you don't want to give this money back. So from the 130, I just take the 70 that you already took and you get the difference. Now, another question was also asked. What if you are deceased before you have paid back this? So for members who stand to get a bigger amount, we are also advising that they can opt to take a life cover against that amount so that it does not disadvantage their dependents come that fateful day that they are no more. But for a member who is taking, because as I said earlier, the minimum amount is 5,000 that you can borrow. And I'm sure you can find every possible way to repay back a 5,000, or you can, it's something that you can do without if it does not come back to you. So for that, we would not say go take a life cover on 5,000. But for those who are taking a bigger chunk, it might be advisable for them to take out a life cover. But some of these little nitty-gritties, we will also explain to members once we are ready to roll out the project.
Finally, Mr. Tjiramba, what is the membership of GIPF, and will the fund be able to sustain this scheme, considering that you are likely to receive a high volume of employees who are coming to borrow?
The fund has actuaries. Actuarial valuation every 3 years. So every 3 years, we are able to know the state and health of the fund for many years to come in the future, the way we do our projection. We also know that the fund investments are very sound. The fund currently stands, as per the last audited financial statements, it stood at 167 billion in net worth, in net assets, meaning we have enough assets to meet all our liabilities at any given time in point. Currently, as of March this year, the net worth was standing at close to 187 billion. So the fund is financially sound. So we are comfortable to say we have done all due diligence before we could roll out this fund. That's why, for starters, we have committed about 900 million to kickstart this project. And we are able to scale it up by a couple of more millions going forward, knowing what the uptake and the demand is. Because the funds are there, people have saved, it is there, it's well invested, the returns are good, so we are able to fluctuate. So we are comfortable to say we are doing this responsibly and the fund knows what it is doing.
Mr. Tjiramba, thank you so much for joining us here on Business Today, and we wish GIPF all the best as you execute this long overdue exercise. Thank you so much.
Thank you for having us, and please don't hesitate to have us back.